Hello, everyone. Thank you so much for joining the event this afternoon. My name is Hamza Chaudhry, and I'm very thrilled to be joined here by my classmate, Julia Zolcinska. To give a quick background on myself, I graduated Princeton class of 2019 from the School of Public International Affairs with a certificate in finance, and was an active member of the Julius Rabinowitz Center for Public Policy and Finance, along with some other alumni from our year, Abhiram Karapur and Marina Finley, who are going to be leading a panel on cryptocurrencies later this afternoon. We all decided to launch the JRCPPF Alumni Forum, really just hoping to provide an avenue for some Princeton alumni to stay connected in the world of economics and public policy. And we're thrilled to be hosting our inaugural event today with a fantastic group of young Princeton alumni working in diverse areas of the financial world. Before I hand it over to Julia for some additional introductory remarks, I wanted to thank Professor Atif Mia, Director of the JRCPPF, as well as Pallavi Nuka and Nancy Turco for all their generous support and help in launching this forum and organizing this event today. So without further ado, Julia, please take it away.
Great. So I'll start off with introducing myself. My name is Julia Zolcinska. I'm from the class of 2019 as well. I graduated with a degree in economics, and I got certificates in finance and entrepreneurship. I'm currently an analyst at Cornerstone Research, and I was also very involved with Julius with the center while at Princeton. I was co-chair, and I'm very excited for today's panel to provide insights for alumni who are interested in various finance topics. So we would like to now ask the panelists to introduce themselves. The questions we have provided are, what did you study at Princeton? Where are you working now? And what does your job entail? As well as a fourth final of where you're calling in from today. And so Renee, take it away.
Cool, I'll kick it off. My name is Renee Shalom. I was an economics major. I graduated in 2017. And after briefly working at the Federal Reserve Bank in New York, I went back to school, and I'm currently pursuing a Ph.D. in economics with all sorts of research interests that I could get into details later. For now, suffice it to say, I'm calling in from the Bronx, New York.
Hi, I'm Katy Boettcher. I graduated in 2011, and I studied comparative politics and got a certificate in African studies. I'm currently a vice president at Ara Partners. We are a private equity firm that invests in industrial decarbonization. So I'm involved in both evaluating new deal opportunities, conducting due diligence, working with management teams on industrial growth opportunities, as well as portfolio monitoring. And I am based in Houston, Texas.
Hi, I'm Sara Gupta. I'm an ORFE major. I graduated from Princeton in class of 2019. I work at Briarwood Chase Management, and I've been there for the last 2 years. Before that, I interned there, and we manage about 600 million. It's a hedge fund. We invest in small cap public equities everywhere across the world, and we try to do deep research and invest for the long term, and try to emulate what some of like someone like Warren Buffett did in the U.S. in global markets. So that's a little bit about myself, and I'm calling in from New York.
Hi, my name is Rene Chavez. I also graduated in the class of 19, like our wonderful moderators and Sarang. I was a history major and got a minor in African studies, like Katy. And I'm currently working for Hatch Credit Incorporated, which is a fintech startup based in San Francisco, although I'm calling in from the Bronx right now. I'm an operations analyst there, which, as is common in startups, means I do a bunch of different things and work really all across the business.
Hi, everyone. I'm Sara Durasova. I'm class of 2018, and I studied economics and did a minor in finance. Now I'm and since graduation, I've been at the New York Fed for the past 3 years. I'm in the markets group, and currently I'm a senior analyst on the Treasury markets team. Basically, that involves, we monitor and analyze Treasury markets. That is my cat. Hopefully you can edit that out. So we monitor and analyze treasury markets, and I'm also a trader on the open market operations, for treasuries. And let's see, so in the last question, so I'm currently in Chicago.
Great, thank you everyone for the wonderful introductions. So we're gonna go over to our first question, which is, what trends are you seeing in your area of finance at the moment? How has COVID impacted those trends? How may these trends change in the future?
Cool, so I suppose we're just going down the line for all these questions? Like for all the panelists? Awesome. So I'll open up one beautiful double-edged sword about academic research is that it's very long. So papers today that get published were being developed 3 or 4 years ago. So in that sense, like, I would say that you still have trickling in of papers written about the financial crisis from the last decade. Now, what's cool about that is that it informs, having studied these last 10 years, we see this totally different, so my expertise is not in monetary policy, but keeping it related to the panel discussion and having worked at the Fed, I could say that the monetary authority has gotten comfortable with a totally different regime than was the case 10 years ago, a much larger balance sheet, much lower for longer interest rates. And so seeing how that plays out, now we have a new fiscal regime with the new Biden administration is just willing to tackle on these big projects. And so it's kind of interesting to see how, like, whether or not the research will be able to anticipate the big policy shifts to come, or whether it's going to be, unfortunately, too backwards looking. So hopefully you want to be forward looking. My personal area of research is a little bit more micro focused. I'm in areas called industrial organization. So I'm more interested in more of the micro level. How do various bond markets or equity markets operate? Some of the microstructure stuff, that's sort of the research that I do. But then, yeah, hopefully you want to be, as a researcher, not just backwards looking, but explaining new trends like the role of cryptos. And for example, recent news, the ECB just issued some bonds on blockchain. So that's the type of stuff that I find exciting that I hopefully want to work on.
A very different perspective coming from private equity. The COVID impact on the companies that we're looking at in terms of buyouts, their financial performance in 2020 is obviously not something management teams and ownership groups are excited about being valued off of. So I would say that for a lot of the sectors I'm looking in, that has made finding buyout opportunities challenging. But Ara, where I work, does 2 types of investments. First, buyouts, very traditional private equity approach, and the second being industrial growth, which is infrastructure development projects. And so it's actually been a very good time to initiate those projects because strategic players or existing players just have been more limited in terms of access to capital.
Yeah, I mean, we're kind of starting to see a pretty strong recovery in the economy. I mean, just tracking reported earnings for companies that are, traditionally retail or travel and those kind of companies, you're seeing a strong recovery, and retail sales especially are like posting numbers people haven't seen in 10, 20, 30 years. And so, and the people's savings kind of piling up and, governments doing infrastructure type programs, like Katie said, we think there's going to be a strong kind of recovery in 2021. And, it's not so clear yet because there are some signs of a third and second wave in parts of the world. But, once this is over, we're probably going to see a strong recovery. So it's quite exciting to see, as an investment person.
Yeah, I think I'll address this question, I think, a little bit differently. So personally, I joined Hatch like right before the pandemic hit and had just moved into an apartment in San Francisco, expecting to work in our office, get really excited. I was like team member 19 in this startup, so still very small. COVID hits, we go remote. And so I think we've talked a lot about like broader economy and investments. with COVID. But I think it's also worth noting, like, how to try and scale an organization and deal with a transition from all in office to being pretty much a remote first company through COVID. And so I think that was a really interesting kind of result and direct experience on like our firm in terms of adjusting to new workflows, getting really good at communication over things like Zoom, Google Meet. I mean, and I should also give a little bit background too to address the second part of this, which is, as we noted early COVID, there was a lot of uncertainty as to what things would be happening. And so especially as functionally a fintech interested in lending and banking services for small and medium businesses, the amount of small business churn during COVID created a really interesting opportunity for us to really engage with the market. And so it's really interesting, especially now, as Sarang noted, we're looking at a very strong recovery, how we can position ourselves and what we're looking at with in terms of expansion through this big period of uncertainty.
So this past year was obviously like very exciting, a very exciting time to be at the Fed and the New York Fed. And, you know, I'm very grateful that I guess the timing has worked out like this. You don't really get to experience, you know, like a recession all that often, and, you know, at the Fed. And so you know, obviously it was, you know, that COVID and combating COVID became like our work from day one of the pandemic. So as you know, we brought rates down to zero, we ramped up treasury purchases, and you know, created the various credit facilities. And you know, that I joined treasury markets in actually last summer. So right before that, you know, at the start of the pandemic, I was actually on the money markets team, which is like our short-term funding repo team. So that was a little bit of a shift. You know, I think that this is still, you know, like seeing effects of COVID is still our bread and butter right now. Like we are figuring out, you know, as we'll talk later about inflation, but that's really, you know, top of mind for us, figuring out is this inflationary spike, you know, in the data numbers, is it temporary? Is it, you know, going to last for a while? That's really been top of mind. And also kind of, you know, it's also just important for us to keep in mind the like bigger picture, not just look at the, you know, most immediate data print. And, you know, that actually brings up the question of like the Phillips curve relationship. You know, for the past, like, you know, before COVID, for a number of years, we saw the Phillips curve relationship between unemployment and inflation, you know, breaking down. And so now we're kind of waiting to see, like, is it going to continue breaking down, or is there something new there that, you know, might be happening? So that's kind of the things that have been top of mind for us.
Great. Well, yeah, perfect segue into our next question. You know, a couple of you guys mentioned the COVID recovery, and one of the main kind of consequences of that that people are talking about a lot now is the threat of higher inflation. So if possible, if you guys could kind of first share any perspectives that you individually have on whether you think inflation is going to be a major issue impacting the U.S. economy in 2021, and then sort of second contextualize that and share how your firm or your organization is thinking about inflation and how inflation would impact your particular line of business. That would be great.
Cool. Yeah, so I'll start off by saying, so Sara and I were colleagues, and Sara continued to do the good hard work of staying within the monetary policy macro space. And I ran away from it because I don't know how to answer that question, at least in a way that I feel comfortable publicly making a forecast. So I view that decision-making is not about, I'm not going to answer that question, but I'll tell you what I'm going to do to hedge. In my own personal portfolio, I've bought commodities, and I've bought some treasury, some tips like the inflation protection securities, which are just not super popular among retail investors. Like my dad had no idea that they even existed. And like, why am I doing this? I actually don't think inflation will be huge, in the sense that, why is inflation scary? It's that it's very fat-tailed. And why is it fat-tailed? Because of self-fulfilling prophecy. So I threw a lot of jargon, and so let me just briefly iterate that idea. It's that if people, so self-fulfilling prophecy first, if people believe that prices are going to go up tomorrow or a year from now, they're going to demand higher wages today to offset that. All of a sudden, the scary inflation that you thought might happen will happen. As a result, it's inflation begets inflation. So all it takes is a little bit of jitter to spark a big run. And there's a lot of catalysts for that big jitter. Trump created huge structural deficit, and Biden is continuing it with these lovely infrastructure plans that might be nice at the firm level. These might be great opportunities for hedge fund and private equity. If these aren't funded by underlying tax dollars, eventually investors are going to demand a higher interest payment. So I'd say, like, I'm still personally on my own personal portfolio. I haven't really adjusted equities, but I just bought a little more commodities and started for the first time buying tips. I'll let the professional class, I'm just a mere retail investor, I'll hear the professional takes momentarily.
Well, I similarly don't feel that I'm any type of expert to be answering this question, but I mean, I think it's something that we are certainly concerned about. And, you know, a lot of our portfolio companies are signing long-term contracts. And so the biggest that are related to some type of commodity. I mean, not obviously, since we're focused on decarbonization, it's not oil and gas related, but that there is exposure, whether the companies are participating in power markets or even with plastics recycling, exposure to rising costs of inputs without commensurate increase in whatever their contractual offtake is. So looking at those contract structures is something that we're spending a lot of time on in our underwriting process.
Yeah, I mean, if you look at the, you know, and it's hard to be an expert, like other people said, macros, you know, pretty tough to make money on. But, you know, just looking at the data, it's hard to deny that inflation's everywhere, from, you know, commodities, lumber, any base metals, oil, or, you know, thinking about wages. Yeah, you know, I've been thinking about wages, minimum wages going up. Even investment bankers are getting paid. You know, who knew investment bankers were so underpaid that they needed retention bonuses, right? But, you know, you're seeing wage inflation everywhere from the top to the bottom. And, you know, I mean, thinking about commodities, you know, there's been a huge amount of underinvestment over the last 3 to 5 years because of low commodity prices. And so, you know, that eventually had to show up in terms of higher commodity prices. So, you know, I don't think that's going to change, because you're not seeing any of the commodity companies react to higher prices by increasing capex. So, you know, that's kind of a worrying sign. So, you know, it doesn't show any signs of stopping on that front. And then on the labor side, as Renee said, it's, you know, kind of a self-fulfilling prophecy for labor inflation. And you're already seeing this in signs, you know, fast food restaurants, small businesses finding it hard to hire people. You know, you're seeing labor force participation in, you know, the older cohort of Americans not really picking up from the pandemic lows. And so, you know, you're seeing a lot of people that left the labor market leave permanently and, you know, not return. And so, you know, you're seeing a tightening labor market, and that's necessarily going to lead to higher, you know, wage inflation, I guess. And, you know, the other issue here is it is kind of, you know, from a policy perspective, the government has promised a lot of entitlements that, you know, they can't really afford, like pension, Medicare, you know, just the debt overall. And so, you know, one of the easiest ways to solve this is with higher inflation and, you know, inflate away the value of these commitments you've made in real terms. You know, you can't fulfill them in real terms. So, I mean, you can't, right? So you just make the nominal amount be worth less by inflating it away. So, you know, it's not all bad. It's bad for the financial markets. It's not bad for the people. I think generally higher inflation leads to, you know, generally lower. It's debatable, I guess. I see Rene shaking his head, so I'll leave that part out. But, you know, it's not great for financial markets, but I don't think financial markets need to go up anymore. So, you know, it's fine.
Yeah, so I think I'd concur with everyone here, and like I'm not an expert on this by any means. And so I'd answer this question really thinking about the people who like hatch serves, which is like 99% of the American economy, small and medium businesses, people who don't have very many employees and who oftentimes are really underserved by the current financial infrastructure, especially if you're running a business with like very, very small margins, right? Right now, if you dip under your on your business checking account, you get slapped with a couple $100 fee by most big banks, right? One of the big product features we're working on is overdraft protection for our checking accounts, and really creating and cashback rewards for debit card purchases, all these sorts of things that can really help make a difference in a inflation environment that makes it really hard to run a small business on really squeezed margins, right? So it's I think like Sarang was saying, it's probably bad for certain parts of the finance industry and makes things hard, but it really is going to make a big impact on your local business down the street, and that's what makes it so important that they're fintechs and all these companies really trying to make the financial infrastructure in this country a lot more accessible and friendly towards small businesses.
In the spirit of hedging opinions, I actually realized that I was supposed to give at the start, but you know, here we are, a disclaimer. The Fed asked me to say that, you know, of course, these are my opinions. These do not reflect the opinions or, you know, views of the Fed or the Federal Reserve System. So I just wanted to mention that, as especially now that we're on the topic of inflation. But yeah, I think a couple things. So I really thought what Renee said, you know, is like a big part of something that I'm thinking about, like inflation versus inflation expectations. And it's like a chicken or egg problem. And, you know, for, you know, 10 years after 2008, we had, you know, all these inflation expectations and zero inflation. And then now we've seen some inflation, you know, in the data prints. Kind of surprisingly, without any really inflation expectations coming before it. So it's quite, you know, it's like the chicken or egg problem is very much like on our minds. It's something we're thinking about, like how can we shift from these regimes so quickly from, you know, and I think another thing regarding that is like another thing that's been on my mind is like how, you know, even the experts kind of opinions change. So, you know, Larry Summers, you know, was the kind of one of the main proponents of this idea of secular stagnation, that like, you know, the economy that, you know, the US experienced in the early and mid 20th century is not sustainable. And that's just something that was a blip in history. And, you know, now we kind of have to get used to a more permanently lower growth rate, which, you know, that would also kind of imply a lower inflation rate. However, like this week, you know, Larry Summers was in the news talking about how like, everybody beware, like we're gonna have like high inflation if you know, the Fed doesn't like get on the brakes soon and pump the brakes. So it's kind of interesting to see, you know, that I guess it's comforting to see that, you know, even the experts kind of, you know, can change their minds or you know, it's a very complex topic. So there's not an obviously right answer. And so, yeah, so I guess, you know, we're going to see and we're going to keep watching it.
Yeah, thanks for all those thoughts. If any of you guys have any follow-up thoughts or considerations, I know Renee, you were shaking and nodding your head periodically. Then definitely feel free to chip in.
Oh, so I'll just follow up then on what those shakes and nods were. The brief shake is like inflation. I don't care about, you know. I mean, yeah, everyone's worried that the inflation comes, then the interest rates comes, then my dear equity valuations go pop. Oh, boo-hoo. But I really care about that. That's not why I'm shaking my head. I'm shaking my head because, I mean, people who are hand to mouth, their entire paycheck is going towards grocery and fuel. And we just saw double-digit prints on those core so let me use the correct terminology. Core actually excludes food and energy, but it's a bit of an oxymoron in the fact that food and energy is such a fundamental part of people's household budget. So that's the reason why you care, is that that those wages just might not be able to keep up with the prices of people living hand to mouth. But it's complicated. There are winners and losers, and for sure, people who hold debt, whether that's governments or large borrowers, do benefit in an inflationary environment. So to that end, Sarang was very much on point. And then the nodding, I think, to Ryan sounds like good work. I'll definitely want to hit you up to ask you more about the nitty gritty of how it is you do what you do.
I actually was like Renee talking about debt made me think about the savings rate. So like something that I've been also wondering recently is that basically, after 2000, right now in the news, people are like, there's been a very high savings rate during the pandemic, and now people are going to go out and spend all the money that they've saved on vacations, etc. However, I think I wonder back to 2008, and like how 2008 permanently changed people's like American savings rates. And I was wondering, like, maybe like the recession and the pandemic, like it might not be this, free for all, like all the money that's been saved is going to be spent. I think maybe like we should think about the fact that maybe like the COVID recession has also potentially permanently altered savings rates, or it just the 2008 kind of increase in savings rate has maybe still is still with us. So I'm kind of skeptical of this kind of like large like dump in spending, and we'll see. I don't know if anyone has thoughts on that.
Yeah, I guess this time is different, right? No, we'll see.
Yeah.
No, it seems like, I guess in places where the vaccine rollout has been successful, you're seeing savings rates go down and consumers spending more than they did to kind of compensate. And, I think all of the luxury, you can see, I think, all of the luxury goods companies, right, they're like posting numbers like they never did before. And that's kind of where you're seeing, okay, you can't spend it on travel or on experiences. So, you're going to buy a Louis Vuitton purse or something with it. So I don't know. It doesn't seem like the consumers have discovered the saving bug all of a sudden. But
yeah, I'll briefly agree with Sarang. I don't think that all of a sudden everyone became more frugal. The government literally told them you're not allowed to leave your house for 2 months.
Totally.
The marketplace told them we're not gonna, like, we lost our workers. We can't give you these services. And the doctor said you got to stay home. And all of a sudden the government at the same time said go out, take off your mask, party. Like, this is not just, I'm gonna push back on the belief that all of a sudden we found the inspiration from the good Lord to be more frugal for the next disaster. I don't believe humans are that adaptive, but okay.
Yeah, I mean, and I see what you mean in the sense that like I'm personally like excited to like go on some vacations and stuff that I had been like holding back on. All I'm saying is that like I guess in 2008 there was this surprisingly like large change in the savings rate, and so I was wondering like what kind of like surprising long-term effects will like the COVID recession have on people's spending. But yeah, I definitely know that there is some spending that's coming, obviously. So, and it'll be fun. I was hoping for a while that we would have that reunions would just get postponed to the fall, and yeah, I don't know, my hopes were crushed, but we'll be there next year.
Yeah, I definitely agree on wishing reunions were in the fall. Definitely would have loved to see everyone in person. But I'm curious, and this is, I guess, more a question for everyone else. What the kind of predictions about a speedy recovery from the COVID recession and how that might be impacting people's choices about spending, as opposed to the kind of 2008 era where it did not seem like there was going to be such a speedy recovery necessarily.
Yeah, I mean, look, I think the government intervention helped, right? Like, I think the government said, hey, you don't actually need to save for a rainy day if it rains for everyone at the same time, we'll give everyone an umbrella. And so, I don't know if that's the right policy decision or not. It seems like it saved a lot of jobs, and, the impact of this crisis is a lot lower than 2008. So it seems like it worked, but yeah, after that, I don't think consumers think to themselves, oh, I better buy an umbrella the next time it rains. To the contrary, I think, consumers and corporations, having been bailed out this time, are, likely to continue spending as extravagantly as they did before, if not more. So it's quite, again, it's going to be an interesting economic recovery, I think, over the next 1 to 2 years. Especially if rates remain low,
There are no more follow-ups to that question. We'll continue to our final planned question. And now we'd like to also encourage people who have questions from the audience to send them to the chat, and we'll ask those next. So our final question is, what advice do you have for recent grads and alumni that are interested in your area of finance?
Cool. The abridged version is, if you're planning on getting a Ph.D., take all the math courses you can stomach, all the computer science, build, tool up. Be open-minded in terms of areas of study. And it requires definitely a little bit of persistence and delayed gratification to take yourself out of the job market. I recommend getting a job first, actually, so you could save a little bit, get a taste of adulthood outside of the cocoon of school, hopefully inspire your research agenda. So I'd say, yeah, study hard, work a little bit, tool up, and you got to be patient.
Sure. So for private equity, I think that the path typically to private equity is pretty well known to, I think, a lot of Princeton students. So I won't add to that, but I think the importance of the Princeton network and you being very targeted in sort of what you're interested in, and where there might be an alum or someone that through Princeton there's a connection with, and getting to know them. And then, as you evaluate opportunities in private equity, I think it's important to think about whether this firm has a long runway for continued career opportunities for you in their position. A lot of the original private equity firm I joined as an associate, got promoted to VP, but I didn't think that there was really a long-term career opportunity for me there, just given sort of how fundraising was going, which is really an important element of private equity that is not what you think about when you're looking to get a job in that area, because you're really just thinking about, like, what am I interested in investing in, and what types of deals I want to do. So I think looking at sort of the medium to long-term opportunities at the firms you're considering is really important.
Yeah, I mean, one thing I saw at Princeton, maybe I'll change my advice from what to do to what not to do, because, I always invert. So one thing is, I saw a lot of people at Princeton make the mistake of going into finance because it was very prestigious. And, I like being friends, with people like that a couple years out. I feel like it's a pretty good strategy to be miserable. And so, finance attracts a lot of really smart people because, it's very lucrative, and it's, you're sitting on your desk and make a lot of money for doing nothing and almost providing very little value to the world. And so, the problem is it makes it highly competitive. And so, if you're not passionate about it, it's kind of hard to succeed long-term in the business. And so, my advice to people that are looking to go into finance would be, find, a niche in finance that you are actually passionate about. It could be impact investing, it could be sustainable, it could be bonds. I don't know who likes that, but could be commodities. Whatever you find interesting, exciting, and, something you'd be happy to spend 8, 10, 12 hours a day working on, because, that's kind of what your competition and peers will be doing. So, my advice would be try to find something you're passionate about. And if it's not in finance, do something else. But yeah, that would be my 2 cents on this.
But just adding to that, I think something I didn't realize when I first got into it, and I think just is not apparent to college students, is there really is a diversity of functions within finance. And so thinking like very clearly about what you like to do, what you like about it, and finding, sort of mapping that to the different groups within like an investment bank, for example, like equity research, very different than investment banking, very different than working at a hedge fund, which is also very different than working at a private equity firm. I actually think they're personality traits that make you better suited for one or the other. And so just again, talking to your peers who are a few years older that you knew from classes or whatever, it's a good way to learn about that so that you don't end up in a job you hate.
Yeah, sorry, one last thing is, people love talking about themselves. So, I think the best way to find out, about if whether or not you like a certain job is just reach out to other Princeton alums in that niche or that area and just, talk to them, try to get a coffee, and, you'll find that people are more responsive than you'd imagine. And so, yeah, it's kind of a good way to get to know all of the differences between, and yeah, people do have a pretty monolithic view of finance, but as Katie said, there are really so many different things you can do within it that, yeah, you really have to kind of find your own niche of what you like and want.
Yeah, so I think in agreeing that there are so many different parts of the finance world, join a fintech, join a startup. That is my biggest advice. It's definitely a nice intersection of tech, work, culture, life balance stuff, and still working on a lot of really interesting stuff that finance is and exists in, right? I would say 12-hour days aren't the norm for me. So definitely enjoying that about being out in San Francisco and in the tech space. But the other thing is try and find something to care about with your job. Like for me, I really like that. I feel like the company I work for is actually providing a valuable service for people and their businesses and helping try and to be very, very trite within the Silicon Valley world, make the world better. But yeah, and network and take risks. I was a history major. I did Princeton in Africa before joining this fintech startup. Like it's a weird path to get here for me, but one that I thoroughly enjoyed. And I think the more risks you take, the kind of non-traditional paths into this whole world, the better. Go for it.
Yeah, I think so. A couple of things. I guess first, like the New York Fed, like quote unquote recruiting can be a bit opaque or whatever. So I'll just kind of give a quick summary of it. We do like internships. So I don't know if there's any like people here that, well, we do both undergrad and graduate level internships, but we also take a lot of people from, like their, previous jobs in finance. So you don't really have to do the pipeline of interns to full time. So that is one thing. I guess the undergrad like entry level role in the markets group is a rotational analyst. And you do that for 2 to 3 years. And you do 1 year on a different team each year. Basically, it's like a great way to kind of like, I think the rotational programs are really great to like explore, what you can do. And then I think, all the different like teams. And then, after that, you like apply or like kind of, promoted to like a quote unquote permanent position, as a senior analyst. And, then it's kind of like a similar kind of like hierarchy in terms of like analyst, associate, all of that, like managers. Yeah, so when, I definitely encourage people to look at the Fed from like, coming from like an existing career in finance as well, because we're always taking people, who have like diverse like backgrounds. I think beyond that, I don't know, something I've learned was definitely that like the best time to network is when you're not looking for a job. It's because it just makes the interactions like much more natural. There's no pressure, there's no kind of awkwardness. You're genuinely just trying to like learn about, meet people, learn about their careers, like see what's out there. So I highly recommend that, even though it can seem sometimes kind of like, well, why am I thinking about the next thing if I'm not looking for the next thing? But it's just a good kind of best practice to get into. Yeah.
Yeah, thank you everyone for those career perspectives. we have our first question from a participant here, from John Hoyler, class of 1967. Great to see alumni participation, especially from class of the 60s. The question is, would it be smart in financial terms for Princeton to divest from fossil fuels sooner rather than later?
Yeah,
Ron,
I'll try
ahead.
to take a crack at it, and then, I'll let other people chime in. But, my 2 cents on this are, there are 2 aspects to this. One is the financial aspect. One is like the moral, social, ESG type aspect to this. From a financial aspect, I don't think it makes sense. The finance markets are kind of, they're an adaptive game, and you're playing it with other market participants. Everyone realizes that fossil fuels are not the future. And, so it's no surprise that energy has been the worst performing sector over the last 5-10 years. So, financially, you have to think about the next 5-10 years rather than the last 5-10 years, because you can't earn what the sector earned in the last 5-10 years, right? And so, looking forward, there's no reason to believe that, we'll not be using fossil fuels in the next 5, 10, 15 years. And even the most, optimistic projections call for, oil and gas to be used far in the future. So, I think it'll go down as a percentage of energy used because humanity uses more energy as it progresses. And, at the margin, energy will be added through clean energy sources, but, fossil fuels will remain a big part of the world's energy usage going forward. So that's financially. And then morally speaking, I think divesting from fossil fuels company does little more than virtue signaling, because when you sell stock, it's not like it ceases to exist, right? It just goes to someone else, right? And so the other person who's buying the stock from Princeton probably has lower moral standards, right? And so it's kind of better to stay with the company and tell them to do the right thing, right? And tell Exxon, okay, look, you have these oil fields, you'll get some cash flow out of them, use them to invest in wind, right? Don't go out and explore for new oil barrels, right? But it's not, divesting really doesn't do anything. Like a lot of companies nowadays are, there's a huge vogue to divest from coal, right? But all that does is you're selling the coal mine to someone else who has lower moral standards than you, right? Is willing to buy the coal mine and, run it like crap, fire people, and, have worse safety standards, doesn't care about ESG. They're the ones buying it from you, right? And so, it really doesn't stop the coal mine from producing. And so, the more thing is to just be a responsible steward of capital and, guide these companies in the right direction towards making an energy transition, rather than, saying, oh, we should divest from these companies, which is too, first order thinking and simple minded almost.
Yeah, Ryan, please go ahead.
Yeah, so I think Sarang does make a lot of kind of accurate points about what a financially responsible kind of look on that is. I do think it perhaps misses some of the movements within the political space that are happening and what we might see in the next 10, 15 years in terms of how government regulation and policy will impact all of these markets, right? I mean, we've seen more talk in the last election cycle of a Green New Deal and like a lot of basically injection of government capital potentially into green energy. And I would imagine that also would cut against the viability and profitability of fossil fuels if there are viable replacements, getting a lot of that, I guess, intervention in the market from the government, right? So I mean, I agree with Sarang's points, but I think there could be a political landscape change that could also create some change here.
Yeah, I mean, the one thing I'd say is, like I said before, financial markets usually tend to price in news like that. So, there are lots of people thinking about this issue and saying, okay, how does this affect, the net cash flow effects on over the next couple of years? And, every time Biden comes out with one of these policies, the stocks go down. And so, I think all of these things are basically priced in. And so, to the point that, people are using non-economic factors to guide these decisions, such as, it morally being icky to own these things. I think these stocks are actually undervalued rather than, overvalued, because political legislation will come in and hamper them. And, if you think about how many jobs and how many, tax dollars this creates, and also, the kind of dependence that, society has on energy, it's kind of hard to take this away. And, as for policy, I wouldn't put too much stock into it. I think it's driven more by political decision making, like, why is the Nord Stream pipeline allowed, but you can't make a pipeline in the US, right? I don't know. But anyway, I don't want to get into politics here.
Yeah, if any other audience members have any questions, definitely feel free to use the chat feature that we have here on Zoom. Otherwise, I'll go ahead with just one particular question that I had over the course of the panelists speaking. I think we focused a lot of our discussion specifically around inflation kind of to the U.S., but if anyone here has kind of perspectives on how inflation in the U.S. might trickle and impact international markets, I know, Sarang, you work at a global hedge fund, so if there's any perspectives there, I would definitely be interested in hearing them.
I definitely want to add a brief remark here, since there's a later panel on crypto. I'd say that question answers the viability of Bitcoin and non-government issued crypto assets. Is that if I can't trust Argentina or Venezuela or Zimbabwe to print reliable currency, if I want to I have friends in Argentina in particular, and we talked about bringing dollars in via Bitcoin. So I think that's the new technology that hasn't really been, it's very nascent right now, is that I'm very curious to see the enforceability of capital controls in a digital world with decentralized digital currencies. And I'm getting shaking heads from Ryan. He probably knows a lot more about the infrastructure of how payment system works than I do, although I'd like to think I have some insights, and just maybe I'm putting too much weight on personal anecdotes, but there are
Renee, you cut off a little bit. Would you like to repeat your?
Yeah, so I realized I got cut off. I just said that I saw some shaking of the head from Ryan, and that he might be more expert on payment systems, but I do see crypto as a back door, whether it transforms into like a main gateway. I'm curious, people in the payment space, what they think of that.
And Ryan, please go ahead, especially if you have some perspective on the financial payment space.
Yeah, I mean, I am by no means an expert in the crypto space, but as an armchair analyst take, I think Renee makes a good point about when your local currency is very unstable, the instability, which a lot of people look down on crypto for, becomes a much less important factor. And I can only see that growing as a means of storing wealth in those markets in particular. That said, in terms of what Renee was saying about capital controls on crypto, it's just, I don't see a viable framework. I would love to be like informed or corrected, but in terms of actually being really able to control crypto from like point of like government legibility of the space.
Oh, that's actually my point. So let me be clear. There are current capital controls of moving dollars into Argentina, for example. And so versus much harder to do so when you have a more decentralized system. So I'm saying that crypto breaks capital controls. That was my point.
Oh yeah, fully in agreement.
So yeah, so okay, now we got two people on this team. So
yeah, I'll just pick up on the earlier question Hamza said on inflation globally. I think it's very similar to what you're seeing in the US, where, you're kind of seeing two things is, commodity prices are kind of the same globally. So you're seeing both soft and hard commodity prices kind of go up. And, it's actually kind of scary because, you've seen in the past when especially food prices rise, you've seen more instability in, like in the Middle East and so on. And so it's actually not a great sign for the world. That you're kind of seeing inflation everywhere. And then in terms of labor inflation, it's kind of the same, populist tailwinds that you're seeing in the US apply everywhere else in the world, where, people are kind of sick and tired of the inequality that's kind of been increasing over the last couple of years. And, you're seeing that reflect in kind of, more like Chile recently introduced a tax on, mining, and, so you're kind of seeing these measures all over the world, which generally will lead to more, labor inflation also. So it's kind of a global.
Great. Yeah, very, very helpful perspectives. If audience members have questions, definitely feel free to use the chat feature. If there are no more questions, definitely happy to give some time back to the panelists and the audience members today. Really appreciate everyone's time. This has been a really, really productive discussion, especially someone like me to talk to people relatively recently out of Princeton in the financial world. So thank you everyone for joining, and hope you have a great rest of your Friday and enjoy some of the nicer weather out there, at least in the East Coast.